Exchange-traded funds have become a popular investment tool, offering investors a way to diversify their portfolios and gain exposure to various asset classes. For all the new investors out there that don't want to take as much risk with individual stocks, in this video we will share 3 ETFs that you should consider owning as a beginner investor. First, we will dive into the world of ETFs, explaining their basic concepts and benefits for investors. An exchange-traded fund is a type of investment fund and security that holds a collection of assets, such as stocks, bonds, commodities, or a combination of these. ETFs are traded on stock exchanges in the same way that individual stocks are, allowing investors to buy and sell shares throughout the trading day. They are designed to offer the benefits of mutual funds, such as diversification and professional management, but with the flexibility and liquidity of trading like stocks. ETFs are typically structured as open-end funds or unit investment trusts, UITs. This means they pool money from multiple investors to buy a basket of securities that align with the fund's investment objectives. These securities could range from traditional stocks and bonds to more specialized assets like commodities and currencies. One defining feature of ETFs is that they are traded on exchanges, which distinguishes them from mutual funds that only trade once per day after the market closes. Investors can buy or sell ETF shares throughout the trading day at market prices, which fluctuate just like individual stocks. The price of an ETF is determined by supply and demand, as well as the value of the underlying assets. ETFs are designed for various investment strategies. Equity ETFs track stock indexes like the S&P 500. Bond ETFs offer exposure to fixed income assets. Commodity ETFs follow the prices of resources like gold or oil. International ETFs provide access to foreign markets, while sector ETFs target specific industries. Thematic ETFs focus on trends like clean energy or AI. Inverse and leveraged ETFs are more complex, aiming to profit from market declines or amplify returns. Since their introduction in the early 1990s, ETFs have seen explosive growth in popularity. The first ETF, the SPDR S&P 500 ETF or SPY, launched in 1993 and remains one of the most actively traded ETFs today. As of 2023, the global ETF market has grown to over $10 trillion in assets under management, with thousands of different ETFs available across a broad range of asset classes and investment strategies. It's a common misconception that buying shares in an ETF or index fund gives you direct ownership in the underlying companies. In reality, when you invest in an ETF or index fund, you own shares in the fund itself, not the individual stocks within the fund. The fund, typically managed by an investment company, owns the actual shares of the companies in its portfolio. Your returns are tied to the performance of the fund, which in turn is based on the value of the underlying assets it holds. Because you don't directly own shares in the companies that the funds invest in, you don't get the rights typically granted to individual shareholders, such as voting rights. Voting rights allow shareholders to participate in decisions like electing board members, approving mergers, or influencing corporate policies. These rights are only granted to direct owners of a company's stock. When you hold an ETF or index fund, those voting rights belong to the fund manager, not you. This is a key distinction that separates owning shares in a fund from owning individual stocks. What's really happening when you invest in an ETF or index fund is that you're spreading your capital across a diversified portfolio of stocks according to how the fund allocates its assets. The fund managers decide how much to invest in each company based on the fund strategy, whether that's tracking an index like the S&P 500 or focusing on specific sectors. While your investment performance mirrors the fund's returns, you don't hold an actual ownership stake in the companies themselves, nor do you receive the associated privilege like voting rights. In contrast, when you buy individual shares of a company, you become a direct owner with all the accompanying rights and responsibilities. This includes voting rights, the potential to influence the company's governance, and direct claims on the company's profits through dividends. In summary, ETFs and index funds offer exposure to a broad range of companies, but they don't confer the ownership benefits that come along with holding individual stocks directly. Now, let's dive into 3 ETFs that you should consider owning as a beginner investor. Number 1, iShares Russell 1000 Growth ETF. One of the 3 ETFs beginner investors should own is the iShares Russell 1000 Growth ETF, ticker symbol IWF. IWF is a popular fund for investors looking to gain exposure to large and mid-cap stocks in the United States. This ETF is managed by BlackRock, the largest asset manager globally, which holds a dominant position in the ETF market through its iShares brand. BlackRock's iShares line offers a broad range of ETFs, and IWF is one of its flagship funds, focusing on growth stocks, companies that are expected to grow at an above-average rate compared to other companies. The iShares Russell 1000 Growth ETF tracks the Russell 1000 Growth Index, which consists of approximately 500 to 600 U.S. companies that exhibit growth characteristics. These characteristics are usually determined by factors such as earnings growth, sales growth, and price-to-book ratios. The fund is designed to give investors diversified exposure to companies that are leaders in innovation, technology, and other rapidly expanding sectors of the economy. Key holdings in the fund include some of the world's most valuable companies: Microsoft, Apple, Amazon, Nvidia, and Meta, formerly Facebook. These tech giants make up a significant portion of the ETF's portfolio, reflecting the heavy weight towards the technology sector within the Russell 1000 Growth Index. This concentration in tech stocks has driven the performance of the fund over the recent years, given the outperformance of technology and digital-based businesses in the U.S. economy. The fund has delivered varying returns depending on the time horizon considered. In the current year, the iShares Russell 1000 Growth ETF has returned approximately 20%, reflecting its resilience and recovery potential in a market environment characterized by inflation concerns, rising interest rates, and economic uncertainty. However, this recent performance is modest compared to its stellar returns in previous years. In the last 5 years, the ETF returned an impressive 129%, reflecting the strong gains made by tech and growth stocks as companies benefited from pandemic-driven shifts towards digitalization, remote work, and e-commerce. This longer horizon emphasizes the benefits of staying invested in growth-oriented assets through market cycles. IWF is particularly attractive for investors who seek exposure to companies with high growth potential, driven by innovation, market leadership, and expanding revenue streams. Number 2, iShares US Medical Devices ETF. The iShares US Medical Devices ETF, ticker symbol IHI, is a specialized exchange-traded fund designed to track the performance of US companies involved in the manufacturing and distribution of medical devices. Medical devices covered by this fund range from critical imaging equipment like MRI scanners to life-saving devices such as pacemakers, prosthetics, X-ray machines, and other non-disposable medical technologies. These products are essential in the healthcare industry and are used in diagnostics, treatment, and patient care across a wide array of medical settings. This ETF seeks to replicate the performance of the Dow Jones US Select Medical Equipment Index, which is composed of well-established, market-leading companies in the medical device industry. The medical device sector is characterized by continuous innovation, significant research and development investments, and long product life cycles, offering a stable yet growth-oriented investment opportunity. The companies included in this index are at the forefront of developing and distributing products that improve patient outcomes and drive efficiency in the healthcare system. Year to date, the iShares US Medical Devices ETF has seen a gain of approximately 8%. This performance reflects the resilience of the healthcare sector in a challenging macroeconomic environment. Healthcare, especially medical devices, tends to be less sensitive to economic cycles since it focuses on essential products and services that remain in demand regardless of broader economic conditions. Over the past year, the fund has increased by approximately 12%, which, while modest, still indicates steady growth amidst fluctuating market conditions. Looking at longer-term performance, the fund has returned approximately 41% over the past 5 years. This consistent performance underscores the strength of the medical device industry, which benefits from long-term trends such as an aging population, increasing chronic health conditions, and technological advancements. These factors create a sustained demand for innovative medical devices, driving steady revenue and earnings growth for companies in this space. Since its inception, The ETF has returned approximately 491%, making it a solid option for investors seeking both stability and growth. The fund's diversified exposure across leading companies in the medical device industry reduces risk while capturing the upside potential of the sector. This makes the iShares US Medical Devices ETF particularly attractive for investors looking for consistent long-term returns with less volatility than other sectors such as technology or consumer discretionary. The key holdings of the fund include some of the most prominent names in the medical devices industry. Abbott Laboratories, a leader in diagnostics, cardiovascular devices and diabetes care, is a major component of the ETF. Intuitive Surgical Inc., known for its minimally invasive robotic surgery systems, also plays a significant role in the fund's performance. Boston Scientific Corp., another key holding, is a pioneer in cardiovascular and endoscopy solutions, while Stryker Corp. Focuses on orthopedic implants and surgical equipment. Medtronic plc, one of the largest global players in the medical device market, specializes in implantable devices like pacemakers and insulin pumps. Other noteworthy companies in the fund include Becton Dickinson, a global leader in diagnostic systems and surgical instruments, Edwards Lifesciences Corp., known for its innovations in heart valve replacement technology, and IDEX Laboratories Inc., which specializes in diagnostic solutions for animal health and water testing. The presence of these industry giants in the ETF ensures that investors gain exposure to the most advanced and widely used technologies in the healthcare sector. One of the significant advantages of investing in this ETF is its focus on a sector that benefits from long-term structural growth drivers. The aging population in developed countries, coupled with rising healthcare needs in emerging markets, creates consistent demand for medical devices. Moreover, continuous innovation in medical technology, from robotic surgery systems to advanced imaging devices, positions these companies for sustainable growth. From an investment standpoint, the iShares US Medical Devices ETF offers both diversification and stability. Unlike other healthcare subsectors such as biotechnology or pharmaceuticals, which can be highly volatile due to regulatory risks and product development uncertainties, medical devices generally have more predictable growth patterns. The devices produced by companies in this ETF are integral to routine medical procedures and long-term health management, ensuring steady revenue streams. The fund's relatively low expense ratio also makes it an attractive option for investors who want to avoid the higher fees associated with actively managed funds. Additionally, the ETF's diversified portfolio reduces the impact of any single company's underperformance on the overall fund, providing a balanced approach to capturing growth in the medical device industry. Number 3, iShares Semiconductor ETF. The iShares Semiconductor ETF, ticker symbol SOXX, is a fund designed to track the performance of the US-listed companies within the semiconductor industry. Semiconductors, often referred to as the backbone of modern technology, are essential components found in everything from smartphones and computers to automobiles and advanced machinery. The companies included in this ETF are primarily involved in designing, manufacturing, and distributing these semiconductors, which are crucial for a wide range of applications across industries. SOXX is a popular choice for investors looking to gain exposure in the semiconductor sector, which is known for its rapid growth and innovation. The fund seeks to mirror the performance of the ICE Semiconductor Index, an index that captures the performance of some of the largest and most influential semiconductor companies in the world. As the semiconductor industry has been pivotal in driving technological advancements, SOXX offers a convenient way for investors to participate in the growth potential of this sector without having to select individual stocks. One of the key reasons to consider investing in SOXX is the ETF's focus on companies that are leaders in the semiconductor space, from chip designers to manufacturers. The sector is known for its cyclical nature, as it is heavily influenced by the demand for electronics and advancements in technology. However, the growing need for semiconductors in emerging fields like artificial intelligence, autonomous vehicles, and the Internet of Things, or IoT, has led to a sustained increase in demand. This long-term growth trend positions SOXX as an attractive investment for those looking to tap into the evolving technological landscape. The fund's holdings include some of the most prominent names in the semiconductor industry. Broadcom Inc., AVGO, is one of the top holdings, known for designing and developing a range of semiconductor devices that are critical for networking and broadband communications. NVIDIA Corp., NVDA, another key component of the ETF, is a leader in graphics processing units, GPUs, and has been at the forefront of advancements in gaming, data centers, and AI. Advanced Micro Devices Inc., AMD, is also a major holding renowned for its high-performance processors that are widely used in gaming, computing, and cloud services. Qualcomm Inc., QCOM, a dominant player in wireless communication technologies, is another significant holding. Qualcomm's semiconductors are essential for mobile devices, and the company plays a vital role in the development of 5G technology. Taiwan Semiconductor Manufacturing Company, or TSMC, is a global leader in semiconductor manufacturing and is responsible for producing chips for many of the world's top technology companies. The inclusion of TSMC in the ETF adds valuable international exposure, given its critical role in the global semiconductor supply chain. Applied Materials Inc., AMAT, which specializes in the equipment used to manufacture semiconductors, and Monolithic Power Systems Inc., MPWR, known for its innovative power solutions, are also key holdings within SOXX. Together, these companies represent the various stages of semiconductor production, from design and development to manufacturing and distribution. The semiconductor industry's growth has been fueled by a variety of factors: the ongoing transition to 5G, the expansion of cloud computing, and the increasing integration of AI into everyday devices all rely heavily on semiconductor technologies. Moreover, the electrification of vehicles and the adoption of renewable energy solutions further bolster the demand for advanced semiconductors. As such, investing in SOXX provides exposure to a sector that is essential for powering the next generation of technological advancements. Which ETF piqued your interest? Share your thoughts below, and don't forget to like and subscribe for more valuable content.